Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to talk about property, plant, and equipment. These are what we call the long-term assets, also known as long-lived assets, also known as permanent assets. Property, plant, and equipment. These are the long-lived assets, things that last for a long time. Throughout this discussion, we'll talk about the impact on the balance sheet with property, plant, and equipment. We'll also discuss natural resources and intangibles. Natural resources meaning the physical stuff, the stuff that comes from Mother Earth. You know, the lumber, the wood from the trees, the soil from the ground, the mining stuff like ore, oil, and other natural things that come from Mother Earth. So we'll talk about how to account for things like that. We'll also talk about intangible assets like patents or trademarks or ideas, things we cannot physically touch. That means intangible. So let's talk a lot about those things. And of course, I can't talk about property, plant, and equipment without talking about this thing called depreciation. Depreciation is, over time, our long-lived assets like property, plant, and equipment, they lose their usefulness. They break down. The building starts to fall apart. The equipment needs to be repaired. The property is not maintained. So over time, these things lose their usefulness. And so we need to account for the loss of that usefulness. We call that depreciation. We'll talk a lot about that. So the first thing is, how much does property, plant, and equipment cost? What's the cost of it? Well, it depends. Property, plant, and equipment is defined by its usefulness and what it's used for in operations. Things that are property, plant, and equipment are things that are tangible. They're used in day-to-day operations of the business. They expect to generate revenue for us. I use my building. I use my equipment. I use my land to help me to generate revenue. Call that future benefit. And these things are called property, plant, and equipment on the balance sheet. So, over time, property, plant, and equipment, they lose their usefulness. They become less useful. Think of like a car that we use for the business, for the job. I'm going to use an example of a dump truck, okay? A dump truck is a vehicle that dumps dirt. Yeah, that's a dump truck. And it's used in construction business. Yeah. That dump truck cost me $25,000 when I first bought it. That's the cost of acquisition. That's my acquisition cost, $25,000. That's how much I paid for it to buy it, $25,000. That's my acquisition cost. Sometimes you can buy a dump truck with like additional stuff on it. It has an improved engine. It has a unique feature on it. So you got to pay a little extra for those things, yeah? We add those to our acquisition cost. And then sometimes you get the dump truck delivered to you. So that's also a part of the acquisition cost. And then you have to pay insurance on it when you first get it, acquisition cost, or while it's in transit. Okay. Those are all part of what we call the acquisition cost, to acquire it. Because it's not just the purchase price. It's the purchase price plus the cost to get it to you, plus the cost of insurance to transport it to you, plus the transportation fee to get it to you, plus whatever else. Add all those together. That's the acquisition cost. So purchase price is different from acquisition cost. It's the purchase price plus everything it takes to get it to you, for you to acquire it. That's what I call acquisition cost. So the first thing we do is find our acquisition cost. So in my example, I'm going to say it was $25,000 flat that included the cost of everything to get it to me. So acquisition cost $25,000. Now, over time, that dump truck, it's going to use its usefulness. It's going to wear down. It's going to break down. It's going to have problems later on. Because I'm going to use it and it's going to wear out. That's how all things with mechanics work. They wear out over time. A brand new car is not brand new 5 years later. It's usually suffering through mechanical issues because you used it. Right? So we need to recognize the decline in its usefulness over its lifetime. Okay? We call that depreciation. So the second step is, how long is this thing going to last? Now, we can find out how much things are supposed to last us through this thing called the IRS depreciation schedule. And it tells us, on average, how long things are supposed to last. In my example, my dump truck will last me for 5 years. Okay? And at the end of its useful life, at the end of the 5 years, how much is it worth? What's the scrap value? We call it disposal. So I can calculate the depreciation of that dump truck over time. I take the cost minus salvage value divided by number of years. We call that straight line depreciation. I'll show you what that looks like. But first, let's talk about the acquisition cost. It's the purchase price plus everything else it takes to get to you, to get it ready for use. Yeah. So it's the purchase price plus the cost of transporting it to you, plus any kind of modifications you need to do to it, plus whatever, right? To get it ready for use. So it's purchase price plus all these things in order to get it ready for use. With respect to machinery and equipment, it's the purchase price plus the sales tax you had to pay, plus the transportation charges to get it to you, plus the insurance while it was in transit. In other words, the insurance you had to pay to get it transported to you in case something happens while it's in transit. Plus the installation of the machinery, plus the assembly of the machinery, plus the testing of the machinery. These are all factors of the acquisition cost. We add all these things together to equal the total cost of acquisition for the machinery or the equipment, whatever it may be. For buildings, it's the cost of purchasing the building, or if you're building it, cost of construction, plus titling fees, plus attorney fees, plus taxes you got to pay on it, plus brokerage fees. All these things, you add all these together to equal the total cost of acquisition for your building. What about land? Land, okay, this is the only exception with depreciation. Land never depreciates. Land never depreciates. Only property, only the plant, the building itself depreciates, and any type of equipment, machinery. The building, equipment, and machinery, those are the only things that depreciate. The land, the physical dirt that the building sits on does not depreciate. Dirt, land, does not depreciate over time. The reason is because land is considered to be infinite. I can bulldoze that building and put another one in its place. The land still has value. So the land does not depreciate. I can actually appreciate the land by improving it, putting in a parking lot, driveway, fence, sidewalk, shrubs, lighting systems, etc. The cost of acquisition for land includes things like purchasing the plot of land, plus insurance for titling, plus property taxes, plus surveying fees, plus title and search transfer fees, plus real estate commissions. All those things added together equals the total cost of the acquisition of land. Remember, land itself, the dirt that you bought, the land that sits below the house you're in, the land itself does not depreciate in value. The building, however, does. That's why, like, example, 2021, 2022, you see the housing market go nuts, right? Oh, the value of all these properties went up a lot, considerably. Okay?
Yeah.
Couple reasons for this now, Mike. Couple reasons. Now, the reason why the housing market went nuts, the values of all these properties went up. Land is at a premium. Okay, land is hard to find. I can't keep putting houses on top of houses. Okay, so because I'm running out of land to put houses on, the value of the land goes up. The building does not go up. It's the land. It's the land that goes up in value, not the building. The building actually goes down in value because the building's going to break down. That's why homeowners and property owners need to take care of the house, of the building. They got to keep up on the maintenance and all that jazz. The building is not going up in value. It's the land it's on is going up in value because land, we're running out of it. We're running out of places to build. That's why we see the value of houses go up. It's not the house itself. It's the land that it's on. That's just a little inside info on that. So if you're ever wondering, hey, why is the price of this house gone up so much? It's not the house. It's the land that it's sitting on. Okay, here's an example. So we purchase land and buildings based on their fair market values. The market tells us how much things are worth. You know, for example, your car, okay? Your car right now it's weird. Right now it's a real weird time. So don't take a used car into consideration in this example because that is a totally weird situation with the car market. But the reason why we see used cars going up in value right now is because it's relative to fair market values. Because they're harder to find, because new cars are harder to find, the value of used cars went up, which is unusual. That's like once in a lifetime type of thing. All right. So it's all about the market. If I can't find enough of something, the value of something else goes up. That's how the market works. I heard somebody's Xbox going off, so if you're playing video games while you're listening to my lectures, knock it off. I'm kidding. Kidding, of course. Okay, so the cost of acquisition of the building and land looks something like this. For example, CarMax, which is a auto dealership. There's a couple of them around here in D.C. They paid $90,000 in cash to acquire some land, valued at $40,000, and a building, a vacant building, $60,000. So $60,000 for the building, $40,000 for the land, $90,000. That's obviously missing a zero here in D.C., right? A couple of zeros. So So we have building and we have land. We bought it on a lump sum purchase, the building and the land together, for $100,000. The company estimated 60% for the building, 40% for the land. So we have what's called an apportioned cost. We apportion the cost based off of the appraised value. It's just an example of how that looks. Let's talk about depreciation, because this is probably the most important part about this chapter and about what I want you to understand about property, plant, and equipment. But more plant and equipment, not so much the property, right? Property does not depreciate. The land itself does not depreciate. The building and the equipment and the machinery, those depreciate in value over time. They lose their usefulness. Okay, so depreciation is how we represent the loss of usefulness from the equipment, machinery, the building over time. Now I'm going to show you what that looks like. First, there are three amounts you need to get, or $3 amounts you need to find. First is the cost. Remember, the cost is not just the purchase price. It's the purchase price plus everything it takes for that asset to be used, right? So it's the purchase price plus getting it ready for use, right? All those other fees you got to get in order for you to get it. The cost of acquisition, not the purchase price. So cost of acquisition is number one. First thing you got to find. The second one is called salvage value. Salvage value is the amount that it's worth at the end of its useful life. Going back to my dump truck example. Okay, I bought a dump truck for $25,000. That was my acquisition cost. It was probably $22,000 was the purchase price plus another $3,000 for various expenses in order for me to get it delivered to my business, and ready for use. So $25,000 total acquisition cost. I was told that at the end of its useful life, it has a scrap value. Scrap value means how much it's worth at the end of its useful life. An example would be your car. Your car, it goes down in value over time, and eventually it will no longer be useful, right? And now it's nickel and diming us, right, as they say. So it has what's called a salvage value. It's the scrap value. How much is the metal worth? How much is the parts worth? That's what we call scrap value or salvage value. So $25,000 was my acquisition cost. It has a salvage value of $5,000. Okay, so $5,000 at the end of the useful life. The useful life, according to the IRS depreciation schedule, is 5 years. So remember those amounts. $25,000 acquisition cost, $5,000 salvage value, useful life of 5 years. There are 3 different methods of depreciation. First is called the straight line method. The straight line method is where we depreciate the same amount each year over the useful life. So in my earlier example of the dump truck, $25,000 acquisition cost minus salvage value $5,000. Guess what that equals? $20,000. Divided by 5 years. So $25,000 minus $5,000 divided by 5 years. So $20,000 divided by 5 years. I always forget what that is. It's something. 20,000 divided by 5 years. It'll be that amount, whatever 20,000 divided by 5 years is, each year for 5 years. That would be my depreciation amount. That we call it straight line. The reason why I call it straight line is because it's the same amount each year for the useful life. The second method of depreciation is called units of production. We depreciate the value of the asset over time based on the units of production. How many units I can expect to produce, to make, with this asset. That's the units of production. We'll talk about that briefly. And the third method is called double declining balance. It's the straight line percentage times 2, double declining. We'll talk about that as well. So here's another example. Let's say I bought a piece of machinery for $10,000. It has a salvage value of $1,000. That means I have a depreciable cost of $9,000. It has a useful life of 5 years. And I can produce 36,000 pairs of shoes with this piece of machinery. Let's say on Nike, I don't know. I'm just throwing it out there. So let's take straight line depreciation first. Straight line depreciation works like this. We take the acquisition cost, $10,000, minus the salvage value of $1,000, gives us a total of $9,000 depreciable cost. $9,000 divided by 5 years is $1,800 per year. So at the end of each year, I record an adjusting entry. My adjusting entry is to recognize the depreciation for this piece of machinery at the end of each year. So at the end of each year, for a total of 5 years, I will debit depreciation expense, $1,800, and credit accumulated depreciation, $1,800. Now, that's a new account. You probably haven't heard that one before, accumulated depreciation. Remember, the word accumulated means we build it up over time. We're accumulating it. Yeah, we're building it up over time. So accumulated depreciation, we see that it holds a credit balance. Debit depreciation expense, increase our expense on the income statement. We're crediting accumulated depreciation. Accumulated depreciation, this is an asset account. But this is an asset account that holds a credit balance. That means that accumulated depreciation is a contra account under assets, meaning it has a negative balance, but it's an asset. So that's how I reduce the value of the asset without actually affecting the value of the asset on the balance sheet. And I'm going to show you what that looks like. So straight line. The formula is very straightforward. This is your acquisition cost minus salvage value divided by useful life, 1,800. At the end of each year, the journal entry is debit depreciation expense, 1,800. Credit accumulated depreciation, 1,800. I do that consecutively for 5 years. At the end of the 5th year, it should have a value of the salvage amount. In this case, $1,000. On the balance sheet, it's the acquisition cost minus accumulated depreciation. Accumulated depreciation goes up over time. Accumulated depreciation, again, this is a contra account. It's an asset. It's a negative balance asset. It's a credit balance asset account. It's a contra account. Accumulated depreciation. Over the 5 years, I can see exactly what's being depreciated over the 5 years. Straight line depreciation is very straightforward. It's acquisition cost minus salvage value divided by useful life. So $9,000 divided by 5 years is $1,800 per year for 5 years. I can find what I call my depreciation rate based off of the schedule. The depreciation rate is the percentage of which is depreciated each year for the 5 years. So depreciation rate is 20% each year for 5 years. 20% by plus 20%, 20%, 20, that's 100% at the end of 5 years, yeah? 20, 40, 60, 800. That percentage is going to come in handy when we talk about double declining balance. Okay, so I can also say, if a question comes up and it says, what is the book value at the end of year 4? You could figure this out by adding all the accumulated depreciation that happened in the previous years and subtracting that from your cost, the acquisition cost. That will give you book value. At the end of year 5, we see that it has a book value of $1,000, which is the same amount as the salvage value. Because salvage value does not get depreciated. Salvage value is the scrap value of what it's worth at the end of its useful life. That's why we don't depreciate it. Now, the second method I wanted to show you is units of production. This is where we identify the amount of units that I can produce with this piece of machinery over its useful life. So I take my cost, $10,000, minus my salvage value, $1,000, divided by the total units I can produce with this piece of machinery. That gets me my depreciation per unit. Per unit. That's the first step. Cost minus salvage value divided by total units of production. That's how I find my depreciation per unit. The second step is to find the depreciation expense. I take my depreciation per unit times the number of units I have produced during that accounting period, during that year. Using our example, cost, $10,000. Salvage value, $1,000, so $9,000. So $9,000 divided by the units I expect to produce, 36,000. So 9,000 divided by 36,000, that's 25 cents per unit. Once I find my depreciation per unit, I go depreciation per unit times the number of units I expect to produce during the accounting period, during that first year. 25 cents times 7,000 units I expect to produce during that first year equals 1,750. 1,750 is my depreciation expense for year 1. I follow that same process for each subsequent year. So first year was 7,000 units. The next year I did 8,000 units. Following year I did 9,000 units, then 7, then 5. Until I got a total of 36,000 units for the life of the machine. My total depreciation expense should equal $9,000. So number of units times depreciation per unit, that's your depreciation expense per year. You do that for each year. You add them all up at the end of year 5, it should equal the total depreciation expense for that piece of machinery. In this case, it should be 9,000. If it's more than that, that's a problem because we got to make sure that we still have a salvage value of 1,000 at the end of year 5. The third method of depreciation is called the double declining balance method. This one's pretty easy. We take our straight line. First, we find our straight line percentage. How do we find the straight line percentage? We take 100% divided by its useful life. In this example, 5 years. 100% divided by 5 years is 20%. 100 divided by 5 is 20. The second step is I find the double declining balance rate. Very simple. 2 times the straight line rate, 20%. 2 times 20% is 40%. The next thing I do is I take the double declining balance rate, 40%, times the book value. Book value in year one is $10,000. That's the cost. So for year one, my depreciation expense is $4,000. For year two, it's $2,400. How I got $2,400? I take my beginning book value minus the depreciation expense to get the beginning book value for the next year. Beginning book value times 40%, 2,400. Then I do the same thing again the next year. I take I take the 2,400, subtract that from the beginning book value to get 3,600 times 40%, 1,440, so forth and so on. You do that until you've reached the end of year 5. In the 5th year, we only depreciate $296 because that's what was left, right? But we see how that works, right? The first year is almost double the amount. That's why we call it double declining balance. And of course, you can compare the 3 different methods. Of course, they're all going to be the same when it comes to the end. But the biggest difference here is how they're used, right? So straight line, it's the easiest. Yeah, a lot of companies use straight line because it's really easy to compute. Some companies will select the depreciation method of double declining balance for their machinery. A lot of times the reason why companies will select double declining balance is because the tax benefit, right? I can write off depreciation in my taxes. So there's a tax benefit to using double declining balance. Units of production, also a little bit more common. Again, its benefit there is writing off through taxes based off of use, right? So, but the most common, straight line. It's the easiest. Then units of production, then double declining balance. But for tax reasons, I mean, I prefer double declining, but it depends. It depends on what the company's objective is. But for reporting taxes, we use what we call the Modified Accelerated Cost Recovery System, which is published by the IRS each year. This is also part of the report that tells us how long things are supposed to last. What happens during a partial year? Let's say I bought my piece of machinery on October 1st. Well, if I bought it on October 1st, that means I only used it for 3 months during that first year. So you could take your straight line rate and divide that by 12 and then multiply it by 3 to find how much you used for 3 months. And that's what that formula looks. Yeah, Esmera, yes, please.
Oh, yeah. Actually, I had a question about when you were talking about the units of production.
Sure.
I was wondering, car manufacturers, a lot of times, like the unsold brand new cars, they rather leave them on a lot, like stored, than to sell them, I guess, at a discount or whatever. And I was kind of wondering if that was more because they were trying to control how many cars were out, I guess, in the market.
That's a good question. So a lot of times, instead of selling a car at a reduced price, they try to sell it at its full value, right? And usually that type of decision is based off of trying to earn the highest profit,
Mhm.
rather than a factor of depreciation. Because with units of production, it's the depreciation is based off of its usage. So once that vehicle drives off the lot, it starts depreciating, and it appreciates based off of mileage.
So is there, I mean, would that be like a write-off for them because they already manufactured it and it's brand new and
Oh,
unused?
for the manufacturer, yeah,
Yeah.
it would be.
Oh,
Yep.
so it's
Yeah.
more of a benefit if they just keep it versus try to sell it at a reduced cost.
Yeah, I mean, the sale really is not going to impact it because the reality is they can depreciate it over time regardless of if they sell it or not.
Okay.
Yeah, good question. Yeah,
Thank
that gets a little tricky, but yeah, it's a good question. Okay, so for partial years, sometimes a company might purchase a piece of machinery in the middle of the year. That's not uncommon. But we still need to recognize the depreciation for that first year based off of when we purchased it. So if I purchase it in the month of October, that means I used it for 3 months: October, November, December. How do I find out the usage? I use straight line method: 10,000 minus 1,000 divided by 5 years. That gives me my straight line times. You could divide that amount by 12 and multiply by 3, or you could just do 3 over 12 and you get $450. And that's just for that first 3 months. You do it either way. It's, whatever's easier. Sometimes estimates will change over time. That's not unusual. So what we do here is, over the life of the asset, we may need to adjust, using adjusting entries, the depreciation time or the salvage value. Here's a classic example. So let's say like you have a piece of machinery, and toward the end of year 4, like it started breaking down, and you're like, oh, if I replace this engine part, I can extend its useful life, making it or be more durable or whatever. So in that case, you would want to revise the estimated salvage value. And of course, that would, if you revise the estimated salvage value, you could revise the remaining useful life. And this example is pretty classic. Like, for example, you have a dump truck. You bought it for 25,000. Had a salvage value of 5,000. Useful life 5 years. Let's say at the end of year 3, that dump truck, you decided, hey, you know what? If I replace the engine, I'll be able to use it for another 3 years, right? So that would be an example of something like that happening. That's when we would make an adjustment to the estimates for depreciation. Sometimes something will happen to your asset, like it'll just not work anymore, lost its usefulness when it no longer works. We call that an impairment. And so we need to adjust for that impairment. So we debit impairment, loss, credit, accumulated depreciation. It's rare. It happens. Sometimes we got to know the difference of repair and replace. Repair, replace. Earlier, very early on, I think I gave the example of the chiller at the hotel. So years ago, I used to be a financial controller for the very large hotel chain in New York. And in that, I had a building, and the hotel, the chiller broke. The chiller is what controls all the air conditioning for the whole building. Yeah, we're talking about a 21 floor hotel. So the chiller broke, right? So we had to make a decision of whether to repair it or replace it. If you're just going to repair something, it's an expense. It's just a repairs and maintenance expense. It's not going to improve its usefulness. You're just putting a Band-Aid on it and letting it limp along until it no longer works at all. That's just repairs and maintenance. The other decision is, if I replace it or if I replace large components of it, it'll last longer. So that makes a difference of whether we recognize something as a capital expenditure or as just an expense. So capital expenditure means we're adding to our property, plant, and equipment. That's capital expenditure. We're adding to property, plant, and equipment. An expense is just an expense. It goes on the income statement as an expense, and it's just a simple repairs and maintenance expense. So these are things that we consider when something like that happens. And that was my example. That happened to me at the hotel, and it was very costly. So yeah, I always like sharing those examples. So we have ordinary repairs. This is just general repairs and maintenance. That just goes on the income statement as an expense. But if we make a repair to a piece of machinery, like we're like a major repair, like we're replacing an engine, we're doing an overhaul, we're by doing that, we're extending its useful life. We call that a capital expenditure. A capital expenditure means we're improving our property, plant, and equipment. It's like when you do like renovations on a building or something like that. So here's an example of the journal entries we would make for that. If it's just simple repairs, we debit repairs expense and credit cash. If it's like we're improving the asset by like a systems overhaul, putting a new engine in, whatever, and we're extending a useful life, we debit machinery or whatever it is, the asset, we debit the asset and we credit cash. That's adding to the asset, of course. What happens when you sell property, plant, and equipment? Or it's done. It's no longer depreciable and reached the end of its useful life. But I'm still using it. Okay? Just because my dump truck is 5 years old doesn't mean it doesn't work. It still works. It's going to nickel and dime me, but it still works. But I just can't depreciate it anymore. So at the end of its useful life, it still works. I just can't depreciate it anymore. So what I need to do is I take it off of my assets. I just expense it out over time. So what do I do here? When I take it off my assets, it's called disposal of assets. I'm not disposing of it. I'm just taking it off my assets. So I'm selling it, basically. Yeah. When I sell it, I would debit the cash I received, and credit a gain off the sale of the asset. Or if it's a loss, like I'm selling it below the cost, then it would be a debit to the loss, and a credit would go to removing the asset. And this just kind of shows us the difference. If the cash that we're receiving is greater than the book value, it's a gain. If the cash we're receiving is less than the book value, it's a loss. Here's an example. I got a machine that cost $9,000. At the end of the year, I discarded it on June 5th, sold it, or discarded it. I brought it to the dump. I don't know. I would use the straight line method. So I would debit depreciation. Debit the accumulated depreciation 9,000, credit machinery 9,000 to represent that I brought that piece of machinery to the dump, basically. It's not no longer useful. Nobody wants it. Throw it up. That's what that kind of transaction is. So what I do is you need to record your depreciation on a regular basis. If you're going to get rid of a piece of machinery and it has not yet fully depreciated, you need to recognize the depreciation up to the current date. So you debit depreciation expense, credit accumulated depreciation up to that current date. And then the second transaction you need to make is the removal of the asset. Debit accumulated depreciation, credit loss of disposal of the equipment, and credit the book value of the equipment. Sometimes we sell stuff. At the end of its useful life, I like to sell it. I don't need it anymore, but I want to get some cash from it. So debit depreciation expense, credit accumulated depreciation up to its depreciated value. And then we recognize the sale. Debit cash, credit accumulated depreciation, and credit the equipment. That's if we sell it. If we sell it above book value, that's nice. Debit depreciation expense, credit accumulated depreciation. Debit the cash that we receive, debit accumulated depreciation for the equipment. We credit gain on sale of the disposal of the asset. We credit the equipment value. And that would be the journal entry for that. If we sell it below book value and take a loss, debit cash, debit the loss, debit the accumulated depreciation, credit the equipment. Natural resources. Over time, we use natural resources to operate our planet. We drill for oil, mine for coal, mine for gold, mine for silver, et cetera, et cetera. We're depreciating natural resources or depleting natural resources over time. We need to recognize that expense of extracting minerals from the earth. So to do that, we take the cost of the mine, or whatever it is, minus salvage value, divided by the tons of capacity or units of capacity. We find depletion per unit, and then we take depletion per unit times the amount that we've extracted to get our depletion expense. It's very, very similar to straight line. At the end of each year, we recognize the journal entry, debit depletion expense, credit accumulated depreciation. This is very common for mining operations. That's what their books would look like. If we sell a mine, I guess, or it remains unsold, we debit depletion expense, debit ore inventory, it's an ore mine, and credit accumulated depreciation. It's very specialized, so that's why it's just an interesting way of computing things. Intangible assets, real quick. Intangible assets are assets that cannot be physically touched. This would include things like patents, music rights, trademarks, things that cannot be physically touched. But there's usually rights involved with them. They're required for operations, and it's difficult to compute their useful life. Patents, copyrights, franchises, trademarks, goodwill, rights of lease, leasehold improvements, research and development, other intangibles, things you cannot physically touch. Another ratio, I know. There's usually at least one ratio per chapter, yeah. This is called the asset turnover ratio. Tells me how efficient my company is at using my assets to generate cash. I take net sales divided by average total assets. To find average total assets, I take beginning of the year assets plus the end of the year assets divided by 2. Find average total assets. Once in a while, you might exchange an asset for another asset. We call it a flat exchange. It's rare. It happens once in a while in commercial applications. Sometimes you can exchange for a loss or a gain. It's just an example of that. It's, again, very, very rare. But here's a journal entry that represents an exchange for an asset. Another example. And my friends, we have reached the end of our conversation on property, plant, and equipment. Any comments, questions, or concerns? Sorry, I went 2 minutes over. We're close, huh? Any comments, questions, or concerns? Okay, as a quick reminder, what's due in the classroom? We're in week 5, module 3. Oh man, we're more than halfway now. Chapter 9, homework assignment. Chapter 10, quiz. Remember, 2 attempts on each homework assignment, 2 attempts on each quiz. Do your absolute best. Try to retain the information. Oh, and I got these cute little exercises I've been telling you guys about. Feel free to work through those. They're not graded, but they're designed to help you to better understand the information. Exercises are not graded. They're just there to help you. Any questions, comments, concerns? You all good? Okay. All right. Well, very good. Well, as always, I want to thank you all so very much for your time today. I appreciate all of your hard work that you're doing in the class. We're halfway. Let's try to, finish this second half of the course real strong. Let's get those grades up and do the right things. If you have any comments, questions, or concerns, you can always email me, call me, set up office hours. Whatever it takes, I'm here for you 100% of the time. And as always, I want you to please stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you all so much. Have a great day.